Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Wednesday, the 7th day of April 2014, and this is the daily report for gold and silver. Under very strong pressure today, we have the precious metals across the board trading moderately to strongly lower. To gold right now, we are trading off about $17 to $18. You can see current print on the screen is $12.8987, and that's just off of a low of $86.20, the high $13.1620. We have sent out a special trade alert. We are recommending that you trail your stop to just below $12.87. Now, we've had a low below this, but right now the market is trading, as I said, about 89, call it 90. And really what I'm looking to do is to protect ourselves. And what we're saying is if it goes below this 50% line right here, we're just going to exit the trade. Of course, we're in at 92. If we're out at 86, we're going to take a loss, but that loss is going to be a small calculated loss, roughly $5-6. Although I'm not happy with that, when we had profits as recently as yesterday, nobody could have foreseen the events that have transpired this morning. More on that in a little bit. Silver also trading lower today, currently trading 1930, 1919 on the low, 1984 on the high. More on silver towards the end of the show. Today we've had two basic things that have really affected the gold market. First of all, we have had the scenario over in Russia change a little bit as Putin announced he's pulling his troops back from the border. That, of course, in terms of the geopolitical uncertainty that has been present, has kind of alleviated that. And we talked about this over the last couple of days, that when you are dealing with safe haven premiums being added or taken away from gold, they can happen very quickly on the turn of a hat, on a dime, so to speak. And the reason being is these statements are going to react in that way. Now, we have trailed our stop. We've trailed it very tight, and this is my thinking here. When we look at this market, we do have a band of support, rough support, as you can see, roughly at 1280. Even though we're below that at 1287, my sense is this: if the market is going to trade into this territory, I certainly don't want to be long in this market if in fact it could come and break below that point. The key right now when we look at this long term is from the beginning of January, we had a tremendous rally, takes us up about $200. We had that 50% retracement plus. Then we had the market come back up, and that was a 50% retracement here of this particular move down. That's how we calculated that. Now, the market has been trading up but a little sideways. You can see the sideways action here, and now we're back to this point again. So the question is the scenario in Russia something that is going to be out of the limelight, so to speak, or is it on hold? My belief is it's probably on hold. I wouldn't be surprised to see something happen in the future. But for the time being, I certainly don't want to be caught with a long position if we break through what I consider to be critical support. The one thing that we notice, and this of course is on a technical basis, we're looking at a daily candlestick chart. Each candle, of course, represents a single day. And if you look at really the size of this candle, this is a $17, $18 move. One thing that we can say is that as this market has come down, it comes down typically with one large move at the beginning, such as right in here or in here, and then we get some sort of follow through. And the key is whether or not we're going to get follow through, because right now, as of yet, we have not really put any long-term damage on these charts in terms of a technical basis. However, we could easily go into that territory because long-term damage would occur really on an interim term. Interim damage would occur if the market broke below the 61% retracement level at about 1262. That's giving up way too much of the most recent rally as this market moved from just below $1,200 to just below $1,400 per ounce. Now, the other thing that we want to look at, I put up the MACD, moving average convergence divergence, along with a simple moving average. Now, the time cycle on this moving average is only 14 days, so it is a fairly short-term moving average, but you can see that this price, the price point right now at 89.50, 89.40 is just below it, is just fallen below this moving average. And my question is now that this market has kind of absorbed the statements that have been made, and we are going to go quickly into our afternoon break before starting to trade overseas, is are we going to get follow through selling pressure as this market hits Australia, Hong Kong, and then London later tonight? We are looking at a 2-day chart, standard candlestick format. And on this chart, as you know, I have basically our Andrews pitchfork, our first, or what we call our handle. That would simply come from the center point, and that's going up to 1900, that high. Then our two other data points are 1800, 1535. And then our handle comes down here. Of course, what we have been following on this is this outer prong, this zero prong, and the fact that the zero prong did, in fact, on this last rally up, break for the first time above this. We saw that, but that, of course, was short-lived, because right after that, really what we saw was the market come down and test support at the 23% level. Now, we have seen this market come up, but if you can see, it hasn't quite made it to this upper outer rung, this zero prong. And so my question is, are we going to now head back down and follow this 23%? Or, as I've said before, we really need to see it break above that to be able to say with any kind of certainty on a technical basis, that we are actually out of the bearish sentiment that we have been in, and these rallies are actually bullish rallies as opposed to a counter trend. Because right now, the way it stands, the best case scenario can be made for the fact that it is a counter trend. Why? Because we haven't been able to make it. This is really that litmus test that we talked about, to be able to break above this particular outer prong. Because as long as it's traded within these cascading channels, there can be no doubt this has been a bearish sentiment and a bear market. This was a real opportunity to see the market break above that. It has not. We'll have to see how this pans out, how this unfolds over the next few days. Now, we're looking at our daily chart, and this daily chart is in Japanese average format, and we touched upon this a little bit the other day, and that is that we are absolutely in a sideways trading market over the last week or so, and you can see that we've got these alternating candle colors. And of course, the one nice thing about the Japanese average charts is defined uptrends, defined downtrends are very, very easy to see visually, because you get a succession of straight red. You also get an absence of these upper wicks. Here you get a succession of straight greens, absence of the lower wicks. Those are the things that we look for, such as in here. Now, you also get periods, and this is what we talked about yesterday, where the market trades sideways. You get alternating candle color, and it can just be a resting area, or a area in which the market itself is really beginning to form some sort of a base, and from that base move higher. Here we are getting mixed signals, because we're hitting the tops and bottoms of the ranges. We're not getting any clear defined color that's happening on a consecutive basis. We aren't seeing the range move above or below these given points, and it's almost trading sideways right within here at about 1310 on the top, and the bottom being at around 1285. And so we really need to break out of this area. And the question is now, with this new news, will it break to lower ground, or will it recover and then begin to move back up? Because if it doesn't, then the current model that we're looking at is not going to make the same kind of a sense. And so we'll really have to see how this marketplace plays over time, especially over the next few weeks. Now, as far as silver goes, we have been sidelined on that market. We have identified that this market is absolutely range bound in terms of the high, in terms of resistance. Ultimate resistance is still just above $20, but we can see these tops at around 1980. The market is trading below 1958. That's a pretty critical area. I'm still showing support at about 1870. So I don't see the market breaking above or below this particular area, and it really needs to, if we're going to see any kind of trend develop to the upside. If it does break, I would look to see how it reacts at these bottom areas, because that would be a point we would consider entering the market. This has been Gary Wagner, wishing you, as always, good trading. Talk to you tomorrow for another daily update and review. Bye-bye.